the politics and the inflexibility of how things are done in those institutions is exactly the opposite, essentially, of how things are done within micro real estate. There is a underlying systemic problem that almost just goes across Europe by now, and that is the lack of housing and how little we are actually of creating more housing. Because the more housing we create, the more flexible the labor market becomes as well.
Like a levered effect actually on the value of the land. Land is valued like an option actually in such projects, and then you could lose it, even if prices haven't moved so much, you can lose like 60%.
The reason why I would put it into listed is, first of all, it's only 100 million, so it's actually quite easy to sort of deploy it, and I would be able to get a nice sort of risk diversification from there.
Welcome back to another episode of Macro Real Invest. Today I have the pleasure to have Olafur, our partner. So Olafur just joined recently Macro Real Estate. So recently it was the 1st of June. And I have the pleasure to welcome you here. Hi, Olaf. How are you doing?
Thank you, Zoltan. I'm good. Thank you. It's a lovely day. It's, not too warm, so I am happy.
No, that's great. As an Icelandic guy here in Switzerland, I can imagine it were tough weeks, the recent ones. So
I sometimes miss the cold and the wind. Let's put it that way.
We would like to introduce you to your viewers, and can you give us your background a bit?
Yeah, like you said, my name is Olaf Margeirsson, but please, everybody calls me Olaf, like there's no one. Indeed, my background. So I'm an economist, PhD in economics from Exeter University in the UK. I actually grew up on a farm in the northern part of Iceland. Studied bachelor's of economics back in Iceland, and then I went to the UK to do the master's and the PhD. Came to Switzerland in 2015, and I started almost immediately with Zurich insurance. I was there for almost 7 years when I called a small bank that used to be big in Switzerland, Credit Suisse.
Yeah, just to come back before that. So actually we know each other because we were both members of the NREF research committee, actually. Yeah. So that's how we know each other. And I remember we wrote together a paper then on WeWork, actually on co-working. I'm happy that we were not as positive on WeWork then. So, but that's how we met, actually. That was the first contact.
It needed some sober analysis. Let's put it that way. Definitely.
Yeah. Then everybody was bullish on co-working. Now, as people are so bullish on AI, so let's see how this will. But we don't want to talk on AI now in this podcast. But so you joined then my former employer, Credit Suisse. So
exactly, and I filled your shoes as the global head of real estate research within the Credit Suisse Asset Management. And then I was pulled over to UBS after the merger, and I was leading the European real estate research there before I joined Macro Real Estate. And that's basically the background in as few words perhaps as possible.
Yeah, no, and you are now around 90 days at our firm. So what is your first impression?
It's exactly the opposite of the big blue tickers that I know from my career past. Obviously I was so I started my career in 2004 by joining the one of the Icelandic banks, Kaupthing back then. And so basically I've been with sort of large institutions my whole career, and exactly the politics and the inflexibility of how things are done in those institutions is exactly the opposite, essentially, of how things are done within micro real estate. It's a bit like the oil tanker versus the speedboat. It's very difficult to change the direction of the oil tanker, but in whatever direction it goes. But the speedboat is it's easy to move its direction in different directions, obviously, and then if things change, then things can be changed.
Yeah, it was quite a big change. Also, it was for me quite a big change coming from this big institution over. So, and we hope we can keep the speed. But let's go to the bigger topics. And also, we both are nerds. We like to talk about markets and investments. And turning to the broader topics, what is your general assessment of the European economy?
It's not bad, but it's definitely not good either. I mean, the PMIs, they are improving. So you have a bit of the short-term sort of improvement. There is acceleration in the underlying sort of data. Growth is still weak though. And more importantly, you still have the lack of energy independence in particular. So essentially it's geopolitically exposed to a high degree. And that basically makes it quite fragile at the same time. And then there is a underlying systemic problem that almost just goes across Europe by now, and that is the lack of housing and how little we are actually creating more housing. Because the more housing we create, the more flexible the labor market becomes as well, because literally you allow people to move around and you allow people
the
to move.
mobility, yeah.
Exactly.
Yeah, absolutely. Yeah.
Once you create the sort of liquidity and the availability of housing in the underlying sort of regions or cities, then immediately what happens is that you basically improve the function of the local economy as well. So fundamentally, it's like I said, it sort of is riding a bit of a sugar high right now with improvement in the PMIs. You still have the underlying problems that actually threaten it. And you still have something that, frankly, Europeans and countries essentially can be this can be solved by literally allowing ourselves to build more housing. That alone would boost, obviously, investments. That would increase GDP. It would increase employment. It would increase wages as well. That therefore consumption through it as well, and it would improve the function of the labor market as well. So, in a way, it's a bit of a straitjacket that we have created for ourselves, unfortunately.
And it's almost across the board, actually, in Europe.
Pretty much.
So if you look from Germany, Spain, and now, so I remember during the GFC when I was selling Spanish mortgages or houses needed to foreclose in Spain. And then we had quite different problems. Then we had the problems that we have lack of demand and an oversupply. But the things also changed in Southern Europe pretty sharply. And actually, like Spain is one of the stronger markets in terms of demand. Yeah. There's probably one market as an exception, that's Finland. So there, it's probably the only market where we currently have an oversupply. Certainly
exactly. And I mean, Finland right now is actually doing a bit it's on the weaker side in terms of the economy. And one reason for it is essentially that it was building so much past, up until maybe 2022 or 2023, essentially, that essentially the oversupply and the supply of essentially the new housing that came onto the market was pretty much too much in a way. You see, you almost, in fact, you saw rents fall in many cases. Housing prices, they sort of were stagnant at best in many cases. And essentially that is almost more of a lingering or sort of a similar problem to what we were experiencing in 2007 and 8, when we were fighting oversupply rather than anything else. But it's a spectrum, obviously. And right now, essentially, you can almost, we can find ourselves in the sort of the opposite sides of the spectrum, where many markets or many economies, they are not building enough. Far from it, in fact. Very few, Finland, very recently, up until recently at least, was perhaps building too much. And we need to sort of, find the balance in the middle.
And then where you see the biggest problem in that, it's that more the politics or
it's the politics, it's the NIMBYs, not in my backyard people, it's the sort of the regulation on the banks as well, because let's not forget, I mean, right now what we are fighting is that exactly because of the crisis that we had in 2007 and 8, and then obviously as well, in fact, in 2010, 11, or 12, up until the Draghi moment in July 2012. Essentially, what we were fighting is that we were fighting an economy that was actually threatening the banking system. And essentially, the regulators, they reacted to it in the classic way of how people react to most recent experiences. They always fight the last war. And so the regulations that were introduced after 2012 and after the crisis in 2008, they were intended to force the banks to take more care of their books in terms of lending to, for example, construction and housing. And what happened was that the banks, they basically just were forced, or they took the business decision after that regulation was built up, to basically not lend into construction anymore. Therefore, we are not building enough. So that was an important part of why we have stopped building to a large extent. But then you had, commodity price increases, building costs were increasing, regulations, perhaps in many cases, they overshot in terms of the quality of the housing that was forced to be built, or as in, if you were going to build something, you were forced to build something that was super high quality. Mid-quality housing, so for the mid-market, essentially became unaffordable to build, and therefore everybody sort of, swung into building a luxury housing where the margin per square meter was obviously much more for the contractor. And here we are not building enough of middle-grade housing.
No, absolutely. And one of the reasons why banks have been on the sideline is also some of them have burned their hands during the 2020 inflation increase. So the issue is also with construction loan, is if then it's like if you value a construction project, you value it in actually a residual value. So
exactly.
So you take the expected sales and distract all the costs, and then you have a margin for the developer, and that's your land value. And the issue was if then, like in Germany, like construction costs increased by 25%, it has like a levered effect actually on the value of the land. Land is valued like an option actually in such projects, and then you could lose it, even if prices haven't moved so much, you can lose like 60% actually in one value. And if you were underwritten it pretty high and optimistically, then you end up in such a situation.
Exactly.
I think some of the like German banks, for example, are specialists in extend and pretend, as we say in the loan terms. So, but it's also one of the reasons why the real estate cycle is still probably 4 years, 4 bad years behind us. So, but where you see the cycle from your perspective, and do you see like a recovery of real estate values?
I mean, we have to a large extent. So this cycle is a bit special. It's not the classic, run by interest rates, sort of, interest rates sort of dropping, and comes a temporary sort of increase, and then you have the crash, and then the recovery sort of comes back on because the interest rates are dropping again. That was essentially the cycle from the 1980s onwards. Now, after the 2022 and 2023 interest rate increases, we've basically not seen the classic, or what we as sort of, nobody out there in the market actually right now has a lot of experience from the whole cycles from the 1980s, literally because we just, we haven't started working on it. But essentially right now, what has happened is that not in this classic fashion, we don't have the drop in interest rates immediately, except in Switzerland. And then essentially what happens is that the market needs to get used to the higher interest rates. It needs to start focusing essentially back on the idiosyncratic risks on the asset level, because the beta driver behind everything, as in lower and lower interest rates, is not kicking in order to sort of, extend the improvement or sort of increase the returns of every single asset out there. So this cycle is a bit special from that point of view. It's not that special in terms of the leasing market, except perhaps for offices, because there you can see the bifurcation happen so massively as it has been. And to my knowledge, this bifurcation dynamic that has been so prominent in the office market hasn't been this prominent in past cycles that we have sort of data on. It's very easy to see, like you can see the prime rents are actually increasing 4, 5, 6% per annum over the last couple of years, essentially since 2024. And those are the sort of the sectors, the markets that have actually been seeing quite a good return over the last couple of years. You had the sort of the value sector or sectors, in particular retail. The returns in there, they were massively driven by the high yields that are basically on the assets because of the valuation correction after obviously the sort of retail Geddon after 2017, and then obviously as well after the increase in interest rates in 2022. And so you need to sort of, it's a bit special from the point of view that you don't have this lowering interest rates carrying the returns of everyone immediately. And second, you need to be super granular in terms of not only the sector and understanding the dynamics per sector. Offices are behaving differently than retail, and logistics are behaving differently from residential, for example. But then also within the sector itself, you need to be very asset selective, so that you are not buying something that is simply not going to give you the risk-adjusted returns that you should rightfully be looking for.
And on the interest rate side, unfortunately, just this week we got some more bad news. Actually, if we're looking at the bond yields, the German 10-year bond yields climbed to 3.25 yesterday. So and now stays at that level, and that's quite threatening for the yields actually.
Of course,
the gap
exactly.
is always is shrinking. So is that also your assessment? So that the $1 million question for the real estate market is certainly, will a yield be able to stay stable this year in Europe, or are we going to see some increases?
That was exactly the question that we had on our desks the beginning of 2022. And I remember very well what the conversation in general, essentially, in the market was. The standard answer was simply, as long as rents will continue to grow, then values should be okay. And fine. That is mathematically exactly the point. But of course, the shock back in 2022 was so sudden and so strong that essentially what happened is that the yields, they simply needed to correct in order for you to be able to mark the valuations of the assets down to something that a prospective buyer would accept buying at in order to get the risk-adjusted returns that the buyer would be getting. Right now, you don't see this sudden shock, and you don't see the strong sort of increase in interest rates that we had in 2022. It's more of a, boiling the frog situation. And therefore, I don't think that we will be looking at any drastic changes in yields. And if there are going to be changes in yields, then yes, they are probably going to be gradual, sort of, upwards, but they are going to be gradual as long as the rise in interest rates is gradual as well. And you can see it actually already. There are little upticks in yields in the prime yields, in the lower yielding sectors as well, or specifically residential, German residential.
Like German residential, I think we will highlight that slide just. There, I was surprised to see that there already an increase. So, but certainly, it's interesting that part has reacted.
And I mean, it has reacted as well, because the confidence in the market is actually quite low in terms of the allowance that the landlord or landlords have when it comes to raising the rents. I mean, everybody is looking at Berlin, and how drastic the sort of the intervention has been in Berlin in terms of allowing landlords to increase the rents. And then obviously what happens is that the market simply starts repricing it according to that.
So you think it's more a regulatory risk premium here and not just like from the interest rate driven?
It has always been like that. But on the margin, it's like basically people have always tried to be very specific in where they are trying to sort of price the regulatory risk on top of the sort of the average or the other market risk premiums that they have. And right now you can see the sort of, the systemic risk in the market is actually implying that the yields they are under pressure because the spreads are too narrow. And then if you have another layer on top of it being changes in the regulatory risk, which, for example, impacts how much you can increase the rents in that specific market, then essentially what happens is that you basically just increase the risk premium accordingly, and therefore you are repricing the asset or assets in line with that.
Yeah, no, fascinating actually. And what I like, what you have developed now are these MRE scores, MRE for macro real estate. So you put that yield also compared to government bond yield in a quantitative context. And I think you have now developed these scores for more than 290 city and submarket, not submarket, city and sector combinations. So can you elaborate on these MRE scores a bit?
Sure. I mean, essentially the development of this actually began within Credit Suisse in 2022. People came to me and asked me that, hey, what's going on? How should we be pricing our assets right now? Should we expect valuations to come down? And if so, by how much? And essentially what I developed was the fair value assessment within that framework. And part of that fair value assessment is to figure out what is the fair yield of that specific market. And the MRE score is literally just following, it's one of the sort of offsprings of that methodology. So it's a part of a package in a way. And the MRE score is very simple. It basically just follows the market. It looks at the historic long-term, essentially, yield spreads in that specific market. It allows for that long-term yield spread to change, because the idea is essentially that the market is changing. Therefore, you should be looking at changes in the long-term spreads that are considered fair in that market. And that long-term spread is compared to the current spread as is. And then essentially what happens is that we basically can score by comparing the distance from the long-term mean or the long-term average of the spreads together with the current spread. We can basically score the markets on the basis of that. And then it's a very simple approach, but at the same time, it's actually quite it gives you a lot of information very quickly. The narrower that spread is between the long-term spreads and the current spreads, the higher the risk essentially the higher the pressure is essentially on yields going upwards. That means essentially if the spread is low there between in the spread today is lower, much lower than the long one, then return to mean essentially tells us that there is a pressure on yields to go up unless interest rates come down. And then exactly the other way around. You can also spot buying opportunities by doing this as well, by simply noticing that if the current spread is far away from the long-term spread, as in higher than that, then essentially return to mean principle, you should be looking at yields coming down, narrowing the spread, and therefore the mispricement in the market is corrected by higher prices and not lower prices like in the other case.
So, and what I like to use this MRE score, which I find quite a useful measure, also comparing that with forward-looking expectation, like what is then the rental growth in that market to have an expected total return. So I think for the clients, what we if we look at should they buy an asset or not, that's one indicator, and we also compare it with forward-looking indicators of supply and demand, certainly, and
Exactly.
But to stay ahead of the curve, that's true that you are updating those on a monthly basis.
Exactly. And the idea, and I mean, you can join this with quarterly data as well, and you should, of course, in terms of, for example, the rental growth numbers and the dynamics there, and then essentially marrying the whole sort of methodology together actually allows us to estimate what the fair value or the fair price of a specific asset is. And when we applied this first within Credit Suisse back in essentially the beginning of 2020 or middle of 2022, beginning of 2023, we often found that the fair price was maybe 10-15% below the valuation, because the valuation actually hadn't been updated. And then came the quarter change or the year-end valuation, and poof, valuation was actually pulled down.
Yeah. And what's interesting now is also that the Swiss market on a relative basis looks most attractive on your score. So,
exactly. And the reason there is very simple. It's because interest rates came down and the spreads widened again thanks to lower interest rates. And then in the non-Swiss markets, you actually have the opposite problem. There, the spreads are too narrow. And you will essentially need to have some sort of a value correction, as in higher yields, in order to actually come back to what would be considered the fair spreads.
No, that's quite insightful, and I think clients of macro real estate also can benefit from this also expertise and also this quantitative inputs. But one last question. So if I gave you 100 million euros to put it in Europe into markets outside of Switzerland, you can choose non-listed real estate funds, probably direct or listed companies. In which sectors and vehicles? So you don't need to give names, but where would you put it?
I mean, it would obviously depend on how much sort of income I would want to take from it. But if I ignore that entirely, I would probably put quite a bit of it into listed real estate. And the reason why I would put it into listed is, first of all, it's only 100 million. So it's actually quite easy to sort of deploy it. And I would be able to get a nice sort of risk diversification from there. More importantly, though, the listed market, it's easier to get currently the exposure to the future sectors in Europe via the listed market than the non-listed, especially if you only have 100 million. And the future sectors that I'm talking about is essentially senior housing and healthcare, and more, obviously, residential. And I mean, residential is well established. It will grow, I think, in the future as well. But you definitely will, I think, see more and more crossover into healthcare, and you have the senior housing sort of gray zone, whether that is healthcare or residential. Independent living, for example, is, I think, an absolutely blatant investment opportunity for plenty of people and investors in Europe, where essentially you're building housing for the people they want to downsize, they want to right size, if you want to put it that term, and they want to access the equity in their current home. They want to have a decluttered home in many cases, and they still want to be sort of, living independently rather than going to a care home specifically. I would also actually consider value add offices, because right now what has happened is that
that's a brave one. That's a brave one.
It is a brave one. But at the same time, you have construction volumes in offices. They are pretty much at a historical low, where if you 15, 20 years, essentially, you can see the construction volumes at those levels that maybe seen last 20 years ago. You, at the same time, have a rise in prime yields. You have a drop in the land values of, and the land values of the value add investments. And that basically just creates this spread that you need in order to generate the value between a value add asset and a prime asset. And if the construction volumes are really low right now, that is actually the time that you should get in to the value add segment, because that is literally just where the supply is lowest right now in terms of new construction that will, or sort of repositioning of the assets that will actually be closing this now wide gap between the prime and the value add. You obviously need to take into account the demographics. I mean, in terms of demographics, it's absolutely horrible for offices in Europe. 20%, if I remember correctly, is the reduction in working age population in Europe until 2050, and that is including immigration. So essentially, you need to ask yourself who is actually going to go to the office. But the mistake that I did in 2021, when I was looking at the office sector across Europe, was to think that the impact from COVID and working from home would be evenly distributed across the sector. What actually happened was that the weaker assets, they were the ones that bear the brunt of the shock. They have now been repriced, especially because of the 2022 interest rate increase. And the valuation of these assets has dropped 20, 30, 50%. And you have generated the gap that you need between the value add and the prime assets, and you benefit and you generate the risk-adjusted returns by closing this gap, i.e. renovate the asset. So I wouldn't throw value add offices off the table.
Great. Like one last question, would you also add data centers to your portfolio?
Sure. I understand it. I mean, it's a fantastic long-term driver. But right now, I feel like if you always have to have the long-term cycle and the short-term cycle in mind. And right now, it feels like the short-term cycle has driven it so high that it will take years for the long-term cycle to actually catch up. And so, I feel a bit insecure about it.
I'm glad you are backing up my decision. Because I've been managing like a listed global real estate portfolio, and which is doing pretty well. So actually, since we initiated it, has been up 14% in Swiss franc, 20% almost in US dollar. And I just kicked out like earlier this year Merlin, which is a Spanish company, but it was my play on data centers. So unfortunately, I did not do the US data center REITs, which made like 35% this year. But on Merlin, we made something over 60% just in less than it was a bit, probably then less than 12 months, which I find that was quite a home run. And since then, Merlin also came a bit, it first went up and now a bit correcting. So, but I'm looking at it because I like that company. Actually, it's probably was too early to sell it, but so that was also my idea actually to go out. So, but still on the private real estate allocation, we're still recommending investors some data center exposure.
Exactly.
As part of their whole portfolio. But I'm so more around 2 to 4%, probably there in that bracket. So I wouldn't do a too big bet on it yet, even as much capital is piled in from the hyperscalers, so from Microsoft, Google, and all that. So, but let's see how that will work out. So.
And I mean, it matters as well, sort of, how you approach it into the market. Exactly. Like, the listed market is probably, it's expensive by now. The repricing is basically, the pricing is assuming a lot of growth to take sort of place, and it's pricing the future growth quite aggressively. But if you are actually the person that manages to actually create the data centers that this future growth is meant to be sort of, taking place in, then that is perhaps the way one should be playing the data center trend in Europe right now, especially because right now it's very difficult to actually build data centers in comparison to the APAC or the US region.
Absolutely. I think these are great final words. I think we got a lot of good content free away in our discussion, and we will continue to do that in future. So not just on the European market, sometimes on the US market or APAC market. So I'm glad that you're on board. So and we wish you also and to all the viewers a great week.
Likewise. Thanks a lot.